Think bonds are just glorified savings accounts? Think again. We're about to explode 10 myths that could be costing you serious money in your investment portfolio. Today, we're diving deep into the world of bonds to bust some major myths. Whether you're a seasoned pro or just dipping your toes in the investment pool, you're about to learn why bonds deserve a spot in your portfolio. Let's get right into it. Myth number 1. Bonds are boring. Let's kick things off with a classic misconception. Sure, bonds might not have the flash and sizzle of the latest tech stock, but boring? Far from it. Bonds are the quiet powerhouses of the investment world. They're like the dependable friend who always shows up on time. Not flashy, but incredibly reliable. I'd be lying if I told you I didn't like it when the regular interest payments hit my brokerage account. I get that look on my face that says, "What are we going to buy now?" Myth number 2. Bonds are only for retirees. If you think bonds are just for folks enjoying their golden years, think again. Bonds can be a smart choice for investors of all ages. They add stability to your portfolio, which is crucial whether you're 25 or 75. I've had bond investments in my portfolio mix since I was in my 20s, and if I had to do it all over again, I wouldn't change a thing. Number 3, you need a lot of money to invest in bonds. This one's a real whopper. While it's true that some bonds come with hefty price tags, there are plenty of options for us regular folks. Treasury bonds through the U.S. Treasury at TreasuryDirect.com can be purchased for as little as $100. That's less than a fancy dinner out nowadays. Way less. I'll put a link in the description, or you can just Google Treasury Direct. Myth number 4. Bond returns are always low. Not so fast. While it's true that bonds typically offer lower returns than stocks, they're not always low. Corporate bonds, for example, can offer pretty attractive returns. Plus, in times of economic uncertainty, bonds can outperform stocks. The other often overlooked aspect is the after-tax return of a lot of investments. Federal, state, and local taxes can really eat into returns. Interest on municipal bonds is often exempt from taxes. This can be a serious game changer for your actual return on your investments. Myth number 5. Bonds are risk-free. You thought this was going to be a show about undoing all the bad things people say about bonds. While I'd love to tell you this is true, this is a common misconception, and I'm going to squash it right here. No investment is entirely risk-free. Even bonds come with some risks. Interest rate risk, inflation risk, and default risk are all part of the game. But here's the kicker. Understanding these risks is completely manageable. When people suggest this misconception, they're often referring to the low default risk on things like U.S. Treasury bonds, U.S. government agencies, and even some municipal bonds. However, there are risks. Heck, if there weren't risks, you wouldn't expect there to be a return now, would you? Myth number 6. Bonds are all the same. This couldn't be further from the truth. Bonds are like shoes. They come in all shapes and sizes. Government bonds, corporate bonds, municipal bonds, junk bonds. Each has its own characteristics and risks. This huge variety creates an even greater chance for portfolio diversification. Spread out that risk. I'll put a link here to a video we did that discusses the different types of bonds we most commonly see in the market today. If you're enjoying this myth-busting journey, don't forget to hit that like button and subscribe. It helps the channel, and it might just bring you good luck in your next bond purchase. No guarantees, though. I'm a bond guy, not a fortune teller. Moving on to myth number 7. Bonds always lose value when interest rates rise. While it's true that bond prices move inversely to interest rates, when yields go up, prices go down, and when yields go down, prices go up. That's always the case. However, short-term bonds, for instance, are less sensitive to interest rate changes than long-term bonds and might be a good place to hide in a volatile market. However, while your price has gone down in the near term, nothing, and I mean nothing else has changed. You're still receiving the same interest payment amount, and you will still receive the bond's full face value at maturity. So if your intention was to hold the bond until maturity, this price action means absolutely nothing has changed for you. Myth number 8. Bond investing is too complicated for the average person. Nonsense. Bonds can get as complex as you want them to, but the basics are pretty straightforward. With a little education, like watching this channel, anyone can become a savvy bond investor. Stocks are way more complicated, and most of you are buying those already. Keep in mind that when you're buying a bond, you know exactly what you're going to get and when you're going to get it. Those interest and principal payments are known to you before you even click buy. That sort of simple certainty is tough to come by in life, much less in your investing decisions. Myth number 9. You can't lose money with bonds. I wish this were true, but alas, it's not. While bonds are generally less volatile than stocks, you can lose money if you have to sell a bond before maturity, but you could also realize a huge gain. Also, you could lose money if the issuer defaults. However, if you hold them to maturity, barring that issuer default I just mentioned, you're going to get the payments you expect, despite market ups and downs. Myth number 10. Bonds are only for income. While many investors use bonds for income, they can also be part of a growth strategy. Here's an example I currently use in my own investing. For the last year, I've been buying U.S. government agency, taxable municipals, and corporate bonds that were issued in the last 4 or 5 years when interest rates were lower. They're paying an interest rate that is lower than the current market, but I've been buying them between 75 and 95 cents on the dollar. So for example, I bought a 20-year bond with a 4% coupon at around $850 per 1,000. I collect that coupon for 20 years, and when it matures, instead of getting $850 back, I'll get the $1,000 face value. This is income, the 4% coupon payment, and growth. My principal going from $850 to $1,000. The added bonus? The bond is callable, so if they call the bond early, I'll get my $1,000 back even sooner. Fine by me. After 30 plus years in the bond market, here's my top piece of advice. Diversify, diversify, diversify. Don't put all your eggs in one basket. Mix different types of bonds. There is such a nice variety. Different maturities. Maybe try laddering them where you stagger bonds each year and reinvest as they mature. And try different issuers. There's thousands of issuers out there. So spread out your risk. Now I know what some of you might be thinking, but Michael, I've heard that bonds aren't a good investment in low interest rate environment. It's a valid concern, but remember, bonds aren't just about yields. They provide stability and regular income. That's when that bond ladder can be a really powerful tool. It allows you to reinvest money at different points in time, allowing you to capture some of those higher rates and not invest everything when rates are lower. I'm curious to hear from you. What's your biggest concern about investing in bonds? Drop it in the comments below and let's keep the conversation going. Here are some actionable steps for you. 1. Assess your current portfolio. Do you have any bond exposure? Perhaps in one of your mutual funds or ETFs. 2. Research different types of bonds and see which aligns with your investment goals and risk tolerances. 3. Stay away from bond ETFs and mutual funds. They do not provide the certainty of individual bonds. 4. Stay open-minded about bonds and discover how they can help you with specific future needs, like paying for a child's college or anticipating retiring in the future. If you'd like to learn more about bond investing, I hope you'll watch one of the videos on your screen now or subscribe to the channel. Always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. See the full disclaimer in the description below.